In the global insurance sector scenario and the regulatory process followed around the world, the government of India came up with the amendments in the existing insurance acts of Insurance Act 1938, General Insurance Business Act 1972, and the IRDA Act 1999. This was done in order to make uh, insurance industry of India more competitive and more beneficial to policyholder and to increase the penetration and density of insurance and help the overall policyholder in the process. So we will go through the uh, brief snapshot of what all exact changes were done. So the first is promotion of foreign investment. Previously, the foreign ownership was allowed only till 49%. But in this uh, in this act, the permissible limit of FDI, which is foreign direct investment, has been increased to 74%. But the interesting thing, in order to safeguard the control of Indian partners in the venture, what government also stated was that the majority of the directors on the board and the key management persons would be resident Indians, and at least 50% of the directors being the independent directors, and specified percentage of profits being retained as a general reserve. And the second is the capital requirement in the government companies. So, as we know that there are four general sector insurance companies. Previously, it was allowed to be in the act. It was told that it has to be totally 100% government owned. But in this amendment, what they did was that these companies were allowed to raise capital, which will help them for the expansion in the and rural areas and enhance competitiveness. And the Indian government ownership was to be maintained at the minimum of 51%. Now we look at the steps taken for the consumer welfare in the amendment law. So we might have seen that there are a lot of mis-selling and misrepresentation by the agents of the insurance companies. So now the penalties have been increased. They have been in the range from 1 crore to 25 crore in case of misrepresentation and mis-selling by the agent. And uh, the policy holder, after purchasing the policy, within the first 3 years, it has the policyholder has a right to repudiate policy and on any of the grounds, not questionable. But after 3 years, policyholder does not get the right. But now, till the 3 years, the policyholder now gets the right to repudiate policy at any time. And now, and the other thing which was done on the consumer welfare was for the easier process of payment to the nominee of the policyholder. So that process has been made easier. It will help the company also discharge of its legal liabilities once the payment is done. And the other interesting thing which was done now, it is obligatory, which is compulsory now for the insurance companies to underwrite third party motor vehicle insurance. Now, this is a very big step we need to see. The reason is that, for example, if companies are left to them, they might not want to enter this segment. Some general insurers might not want to enter this segment as it might be loss making for them. But due to as it being obligatory in its nature, all the general insurers, even if they're incurring loss in this, they have to book certain uh, percentage of business uh, in the uh, third party vehicle insurance. Now we'll look at the how IRDI, the regulatory authority of India, has been how this act has empowered the IRDI. So IRDI now can it has got the power to regulate the key aspects of insurance company operations. For example, solvency, investments, expense, and commissions, and to formulate the regulations for the payment of commission and the control of management expenses. And the other, it also empowers the authority to regulate the functions, code of conduct of surveyors and loss assessors. And previously, you need to, if you want to get your property insured by a foreign insurer, you had to take a permission from central government. But now, with the permission of IRDI, you can take you can insure a property by a foreign insurer by just the permission of IRDI. You don't need to take permission from central government. So this has led to increase in the power of the IRDI. And in the health insurance segment, we have seen that it has included the travel and personal accidental cover also in this, and they have done the capital requirement of this in the business of the minimum capital requirement is of 100 crores so that they come up so that they remove the non-serious players in the industry, which is a very kind of good step. Now we see what this act has done for the reinsurance businesses in India. So now it allowed foreign reinsurers to open their branches in India, and now we see what has it done to the industry council. So there are two industry council, life insurance council and a general insurance council. So they have, so this act has made them self-regulating bodies. So now they're able to frame their own laws for elections, meeting, and collect fees from its members. And now we also see the appellate process. So, for example, any insurer or any intermediary which wants to go against the order of IRDI or feel like this is unfair to them, they can appeal against the order of IRDI to Securities Appellate Tribunal. So previously this was not there, but now they've made it quite a good process for insurers. It's a very good welcome step for the insurers if they feel that the regulations are hampering, if it's getting too much involved, so they can actually, go ahead and appeal against them. Now we see what exactly they did the capital reforms, capital market reforms. We have seen a lot of news regarding the IPOs of the insurers lately. So in this act, what in March 2019, IRDA what they did was it announced it redesigned the IPO guidelines for the insurance companies, which were looking to divest equity to IPO route. So now insurance companies are allowed to invest up to 10% in additional tier 1 bonds issued by the banks. So this was the reform done by the uh, in this act for the companies.